thinking about jumping into the stock market. It's an exciting world, but let's be real, it can also feel like a roller coaster. You hear stories of people making a fortune, but you also hear the horror stories. Today, we're going to break down the real risks and rewards of stock investing, especially for beginners. We'll cut through the noise so you can make smarter decisions with your money. So, what are the big rewards everyone's chasing? First up is capital appreciation. This is just a fancy way of saying your stocks go up in value. You buy a share for $10, and a year later, it's worth $15. That $5 profit is your capital gain. Over time, these gains can be huge, especially with the magic of compound growth. This is where your earnings start to earn their own money. It's like a snowball rolling downhill, getting bigger and bigger. Albert Einstein supposedly called it the eighth wonder of the world for a good reason. Imagine you invest $1,000. If it grows by 10%, you have $1,100. The next year, you earn 10% on the whole $1,100, not just the original $1,000. It starts slow, but over decades, it can turn a small investment into a substantial nest egg. Then there are dividends. Think of these as a little thank you from the company you've invested in. Many stable, well-established companies share a portion of their profits with their shareholders. It's like getting paid just for owning a piece of the company. You can either take this as cash income or, even better, reinvest it to buy more shares, which accelerates that compounding snowball we just talked about. It's a powerful way to build wealth over the long term. Now, let's talk about the other side of the coin, the risks. The number one risk is market volatility. Stock prices can swing wildly from day to day, even hour to hour. 1 minute your portfolio is up, the next it's down. This can be stressful, especially when you're just starting out. This volatility is driven by everything from economic news and company performance to global events and even just market sentiment. It's the price of admission for the potential rewards. The biggest fear for any investor is the permanent loss of capital. This means you sell your investment for less than you paid for it, and that money is gone for good. This can happen if you invest in a company that goes bankrupt, or if you panic sell during a market downturn. It's crucial to understand that investing in stocks means you could lose your entire investment. That's why the golden rule is to only invest money you can afford to lose. Let's look at a real-world example. The dot-com bubble in the late 90s. Everyone was throwing money at any company with a com in its name, and stock prices soared to insane levels. People thought the party would never end, but in 2000, the bubble burst. Companies with no real profits or business models collapsed, and investors lost trillions of dollars. It was a harsh lesson that hype is not a substitute for a solid business. It also showed us that what goes up can, and often does, come down. So, how do you navigate these risks without staying on the sidelines forever? The key is risk management. First, diversification. Don't put all your eggs in one basket. Instead of buying stock in just one company or one industry, spread your money across different types of investments. This way, if one area of the market is doing poorly, your other investments can help balance things out. Second, have a long-term perspective. The stock market is not a get-rich-quick scheme. It's a tool for building wealth over years, even decades. Don't get spooked by short-term drops. Historically, the market has always recovered and gone on to reach new highs. If you're investing for retirement in 30 years, a bad month or even a bad year shouldn't cause you to panic. Third, do your research. Do not just invest in a company because your friend told you to or because you saw it on the news. Understand what the company does, how it makes money, and what its future prospects look like. The more you know, the more confident you'll be in your investment decisions, especially when the market gets shaky. A great way to visualize this is the risk-reward pyramid. At the bottom, you have low risk, low-reward investments like savings accounts and government bonds. They're safe, but your money won't grow very fast. As you move up the pyramid, you get into things like blue-chip stocks and mutual funds, which have moderate risk and moderate potential reward. At the very top, you have higher risk assets like penny stocks or speculative investments. The potential for reward is massive, but so is the potential for losing everything. A balanced portfolio usually has a mix of assets from different levels of this pyramid, tailored to your personal risk tolerance and financial goals. So, to wrap it all up, stock investing offers incredible potential rewards through growth and dividends that can help you build long-term wealth. But it comes with real risks, like market volatility and the potential loss of your money. The key is to invest wisely, diversify your portfolio, think long-term, and do your homework. Remember, never invest more than you are comfortable losing. Start small, learn as you go, and be patient. The journey to becoming a successful investor is a marathon, not a sprint. Now, I want to hear from you. What's your biggest fear when it comes to investing in the stock market? Drop it in the comments below. Let's talk about it. And if you found this video helpful, don't forget to hit that like button and subscribe for more content to help you on your financial journey. Thanks for watching, and I'll see you in the next one.